All right, so for our first panel of this afternoon session, we're going to be talking about the future of ETH staking, how institutions can preserve decentralization. Please welcome to the stage Stephen Pack from Rock Solid, Ken Smith from Rocket Pool, Will Shannon from Lido, and our moderator, William Mougayar from the Ethereum Market Research Center. Round of applause.
Is this on? Yes, it is on. Great. So I'm William Mougayar. I've been in the space for a long time. My current project is a new book called Trust Shift, Ethereum and the Reinvention of Trust. So about this panel, we're standing at a critical crossroad for Ethereum. Traditional finance has arrived with billions of dollars in capital. But let's be honest, Wall Street loves efficiency and yield. But Ethereum depends on continued decentralization. So the question is not whether institutions will stake, because they will. The question is whether their capital would or could centralize the network, and if we can build the infrastructure to make them participants in this decentralization. So to tackle this topic, we have three key players in the field. First, we have Lido representing scale and liquidity. They are the incumbent, the largest player. And they are currently navigating the space becoming more modular. We have Rock Solid, who has structured DeFi products like the looped vaults they're going to talk about that institutions demand and prefer. And we have defending the grassroots of Ethereum, Next Block Solutions, champions of the solo staker movement, and arming everyday users with what they need to do to keep the layer permissionless and decentralized. So with that introduction, I'm going to ask each one of the panelists to say something very quick about themselves and the projects that they are involved with.
Hey everyone, so I'm Will Shannon. I'm the head of node operator mechanisms and a contributor to the Lido DAO. Lido is the leading liquid staking protocol with over 9 million ETH staked. Lido serves both institutions and general DeFi users via ETH, which is a liquid staking token. And looking forward to the discussion.
And good afternoon, everyone. I'm Ken Smith. I'm a home node operator with Rocket Pool. Rocket Pool is a liquid staking token. It also allows individuals to run their own node and stake other people's ETH. It currently represents about 2% of the network right now.
And hi, Steve Pack, co-founder of Rock Solid. Rock Solid vaults offer single-click access to the best of DeFi. The reason we're here, we're kind of a layer on top of these guys to help make those LSTs that are important to Ethereum's decentralization more productive and give more opportunity to the holders.
Great. So let's be brutally honest. Do institutions really care about Ethereum's decentralization, or is it just a marketing buzzword for them? And the question is, if they only care about yields and risk, how do you financially incentivize them to choose decentralized protocols over the centralized ones, for example?
I can kick off. So I think that institutions don't wake up caring about decentralization in the same way that like the community has over the last years, right? I think that will likely end up being a bit of an issue, to be honest, given the way that stake concentration is going to, in many cases, a small group of node operators. But in terms of the incentive to use decentralized protocols, I think that they're aware that this at some point will become an issue. The key really is having the best product, right? And that's what institutions actually need. They need security, and very, very importantly, they need liquidity. And that's been a missing piece in staking. So Lido is the most liquid staking token, and we're seeing success with institutions. So in November, Wisdom Tree launched an ETP in Europe, and so that's 100% staked with Lido ETH. And soon after that, VanEck actually filed an S1 in the US to launch an ETH-based ETF. And so there are certain institutions that are going to want to work with single node operators. Lido's new product, V3, sort of solves that issue. But in general, it's quite tricky because there's a lot of incentive for them to work with single node operators where they have full control and really can customize things in a different way than historically working with a liquid staking protocol kind of looks like.
Yeah, I mean, I definitely think if they're not paying attention to the need to have decentralized node operations, they really should, right? I mean, if you think about it, ultimately, they've made an investment in Ethereum, right? And one of the core principles of Ethereum, besides credible neutrality, is permissionless and decentralization, right? And so at some point, if you come in being the heavy hitter and you start investing in ETH and holding ETH and staking ETH, and you do it in a more centralized operation, you start to rock the boat a little bit more, and all of a sudden the core principle you bought into may no longer be holding true. So whether or not they're factoring that in right now in their early exploration of their use cases of Ethereum, that I don't know, but I think it's something certainly they should be paying attention to and beginning to ask that question.
I don't think they care about the word decentralization, but I think they do care about credible neutrality, right? If you're a corporation and you choose to, do finance on a public blockchain, you care very much that your assets can't be seized and that the operation of that chain can't be compromised, right? So they are implicitly very much buying into decentralization, or they'd use another chain or a private chain. So I think they clearly care about it, but if you have a profit motive to do something against decentralization, like you're in this kind of prisoner's dilemma. So I think if we saw again a single entity come close enough to being able to control Ethereum, then either the system would self-heal in terms of large operators might start to move their stake around, or the protocol would have to respond on the base layer.
So how would you characterize the market right now in a nutshell? Compare 2025 to 2026. And I'd like to know, do you know what percentage of staking is actually institutional? Can we tell? I mean, are you going there to sell them? Are they coming to you? What's the pitch? Because they like to go where there's the least resistance. And if you can talk about, are there any misconceptions, for example, that you have to overcome?
So in terms of the percentage of the network that's staked, that's held by Ethereum, so I don't have like a full clean answer. What I can say is BitMine is, I believe, owns about 4% of all Ethereum at this point. They're deploying all of it into staking. There is like a lot of room to come, right? BlackRock hasn't started staking. The other like large ETF providers haven't started staking. There are institutions active on Ethereum staking today. I think it's probably in the low double digits, if I had to kind of guess. We don't have the exact like information of like STETH holders, for example, but I think it's increasing as a percentage.
Yeah, and in Rocket Pool, we don't really track, who owns or holds the liquid staking token at the end. I think it would be interesting to start exploring that area, right, to see if there is a way to try to put a quantification on it. And I think it's going to be even more interesting as, institutions and kind of their corporate reporting requirements come and they have to start disclosing their investments and holding. Perhaps we'll be able to extract it from there from companies that have self-disclosed which tokens they're holding.
I think just the fact there's been millions of ETH bought by DATs, over the past 18 months, and a bunch of that's getting staked, it's clear that as a proportion, the institutional stake is growing, definitely.
Is the fact that the staking yields are compressing, is that an issue? And is the fact that the exit queues are long, is that an issue? Is that a constraint? And can you talk about that and any competitive dynamics between the node operators and the protocols themselves?
I can maybe take the yield part. Like, definitely that's where we're seeing demand, where there's a certain type of entity that says like 2 to 3% staking rewards is enough, and I'm happy with that with my risk profile. There's definitely another type of entity, and these are becoming more common, that says, and actually I need more than that. I want more than that, and I want to look at DeFi, but hey, I'm not a DeFi expert, so I need something like a vault to provide me this sort of professionally managed entry into DeFi. So as yields go down, like that, there is definitely a pressure for entities to get into DeFi that way. But still, it often starts at the base layer. It often starts with LSTs.
But are you the ones to push them towards DeFi, or?
Pool is always more successful if they come to us, but it's a long-running process, right? It takes time. It takes entities time to get up to speed on what's available, what the risks are, and how to approach it.
Yeah, and I think one thing just to correct, like right now, so it's interesting in staking dynamics, right? Ethereum, the base layer, has a queue, a validator queue, and it goes both ways. Both if you have ETH and you want to stake it on the beacon chain, there's a queue, and if you want to leave the beacon chain, there's a queue, and it limits the amount of validation that can leave and join at any time. And so right now we're actually, there's no one leaving. The exit queue is probably only an hour or something at most, right? But right now the entry queue is long. I think it's like 90 days or more, right? I mean, it's 2 months plus, right? And it's quite significant. So to me that says there's a lot more people with ETH that want to get in and stake that ETH, right? And so this is going to be interesting, and I think the question is really going to come up when, what came up in kind of the core devs or some of the EF presentations is Ethereum paying too much for its security, right? Should they reduce even further the issuance rate for staking, right? And you could see, and so this is where this is where the real interesting argument I think is going to be in institutions. Will they come up into the presentations and really press harder to continue to extract value from Ethereum by arguing for increasing or maintaining the issuance rate, or will they take a lower rate? I don't know. It's going to be interesting.
It will be. I definitely think you need a large security budget for a primitive and protocol that should control secure trillions of dollars of value. And so I think issuance is important. I think let me combine maybe the second part of your last question in terms of where we are in terms of state of the market with yields, right? And so last year, institutions started to I think understand what Ethereum is. There was big changes in regulation. Before that, much of the focus was on Bitcoin and Bitcoin only. And 2026 really is the year of adoption and execution from an institutional staking perspective. And that's despite the fact, and it's also causing the fact that issuance is decreasing, right? The more ETH is staked, the issuance rate decreases as a result of that. And so I think today, institutions are starting to get comfortable, okay, we want to own Ethereum. And if you want to own Ethereum, you most likely should probably be staked. And doing that in a way where you can have liquidity, whether it's with Lido or Rocket Pool or another option, makes a lot of sense. And then you can layer in, as you get more comfort, right? You layer in different mechanisms higher up the risk curve, and that's what the guys at Rock Solid kind of can help you do.
I saw you nodding. I don't know if it was an approval or disapproval to the previous comment. So
yeah, just the question of the issuance. Selfishly, talking my own book.
Let's talk about that.
I mean, it's much easier to sell Ethereum as an ecosystem, to sell ETH-based products, to sell DeFi products that have these LSTs as primitives, if the staking rate is higher. Simple as that. So in terms of helping us increase demand for our products and Ethereum's products, issuance is good. The EF obviously have a different set of priorities, and that's why there's this beautiful push and pull in this ecosystem.
What would you like to see? What's the
Selfishly, I don't want to see it decrease. But I don't know what the optimal number is.
Yeah, I don't know the optimal number too. It's debated, right? And I think it will be continued to debated. I think the core thing, no matter if we're an institution coming in, where we're a home validator, an active participant in Ethereum, ultimately you want the best healthy network of Ethereum, right? And I think the right answer is whatever issuance for Ethereum is right for Ethereum, that's the number that we should get to. Now, how do we get to it and determine it? I don't know. I mean, obviously the LST protocols, Rocket Pool and Lido, it's more attractive to generate interest and have people mint the liquid staking token when the rates are higher, right? But is the rate right now set correctly? Is it too high? Is it too little? I don't know, but I know in the next meeting or the next kind of conversation that they have on it, it's going to be probably 1/3, Ethereans. It's going to be 1/3 institutional representatives, and it's going to be 1/3 agenic people arguing one way or the other on the issuance rate.
If you want a credibly neutral and decentralized protocol, you need sufficient inflation and incentive to support home stakers to wake up, decide to set up nodes, run validators, and do that in a way where they are excited to go through all of the pain of setting it up. And yes, it can be fairly easy, but it's not that easy for most people. And so it's really important to strike that balance of making sure that there's still very good incentive for a significant portion of the network to be run by people that want to run validators themselves at home.
Okay, let's talk a bit more about DeFi again, because we have smart contract vaults that I think Rock Solid have that. It kind of abstracts the underlying node operator from the depositors. The question is, can we talk about the difference between a staking infrastructure vault and a yield strategy vault? A bit technical, but still. Can any of you or all of you explain the difference?
I can take the yield one, and maybe Will can do the staking one. So, yeah, yield vault is simply you deposit an asset that might be ETH, it might be RETH, it might be staked ETH, and then the smart contract deploys that to one or more DeFi protocols. And so, there's traditional things like incentive farming, like leverage looping, like liquidity provision. Increasingly on-chain there are more options like real-world assets, all sorts of different sources of yield. So a yield vault basically abstracts that, not just abstracts staking, but abstracts all of the sort of strategies from a user.
But it also introduces the smart contract risk, right?
Yes, it does. Yeah, it's a different set of risks. It's a different set of trade-offs. That's why the yield is higher, right? And that's why everyone kind of has to choose their point on the risk curve. And we try and tailor our products to meet where we think the market is, and others do the same. But we'll have a take on the staking vault, which is kind of new.
Yeah, so infrastructure staking vaults are really like the centerpiece of Lido's latest upgrade, which is V3. We call them ST vaults, and these are basically like a new mechanism that allow for stakers to just choose the node operator that they want to stake with in sort of like a segregated instance. And so this serves a lot of different use cases, and it's very customizable as compared to staking with Lido Core, for example. So today, if you're an institution, you may want to work with a specific node operator where you sign a contract, you have an SLA, there's certain expectations. And in the past, like maybe you didn't want to stake with a decentralized protocol because you want to have someone to pick up the phone and answer questions if something goes wrong. The cool thing with ST Vaults is you're then able to mint ST ETH against the locked collateral position, which is your ETH deposit. And so you get all these benefits of using an LST, but your own assets are still segregated. They're not commingled in a broader deposit pool. And so this is really just staking infrastructure, but it's very composable. And so you can build DeFi products on top of that by minting an ST ETH, for example, and doing leverage staking or whatever else you want to do in DeFi. So it really sits like the level below where the strategy vaults are, but the strategy vaults can plug and play with the infrastructure vaults. But at its basic level, like it's just another form of staking.
Okay, let's talk about compliance and regulation. Do you think there might be a scenario where there will be some pressure to force the protocols to adopt a KYC style permissioned validator set? And is that a threat? Does it fracture Ethereum's neutrality in some sense? Or comment about regulation and compliance, and what are you watching, what are the risks, and so on?
Yeah, I mean, I actually think the worst is behind us in terms of staking regulation. Like the SEC was famously very vague about what their opinion was, and now it's, they don't seem concerned about staking. Like, I can't remember the name of the term, but it was kind of said, okay. But I think the more important thing is, like, even if that were to be true, even if there was to be an extremely hostile regime in multiple countries, how is Ethereum positioned to respond? And the great answer is very well, because anyone with an internet connection who can acquire 32 ETH can run the network and decentralize the network. And that's why Ethereum's amazing. That's why Rocket Pool, is amazing. That's why CSM serves the purpose. So, yeah, I think that is one of the biggest benefits of Ethereum, that it can defend against like that sort of regulatory attack.
Yeah, no, I mean, certainly here in the U.S., I think the optimism and the forward-looking prospect of having very beneficial and very clear regulatory rules and laws coming is looking very favorable, right? I know there's still some challenges with the Clarity Act, but it does seem like there's still discussions and movement forward there. But one of the things I think that will help maybe alleviate some of that is the decentralization, right? I mean, I think, if I go back 20 years, 30 years to the formation of the internet, there was a lot of concern about just internet traffic and what would happen to internet service providers, and would they have to do KYC, and would they have to look at every transaction and packet, and I think ultimately the government found that, okay, well, if it was decentralized and it was an open public good and utility, and it wasn't it wasn't just owned by single corporations and so forth, or a conglomerate of corporations, that it was much more viewing it as freedom of speech or freedom of internet, right? And I think eventually that's one of the advantages that Ethereum has, is it can make that claim right now, and that's why I think if an institutional investor is here, watching this or on the live stream, right, they should kind of factor that into their decisions and kind of not mess with that.
Yeah, I think like one really nice sign for optimism, right, is we now have a listed product that went through approval using Lido. And Lido has over 700 node operators. The community staking module, which is the permissionless part of the protocol, is now the largest permissionless staking protocol, share of a protocol on Ethereum. It's the biggest. And you have these traditional finance players that did due diligence, understand that there's 700 different participants of this protocol. A lot of them are just single people, and that is trading on European exchanges and hopefully also on American exchanges too. So I think that there is good sign for optimism that Ethereum is what it is, and you don't want to necessarily change that.
Great. So let's fast forward, let's say, to 2030, 4 years from now, assuming that there's going to be a lot of institutional money that dominates Ethereum staking. Maybe you say yes or no, I don't know. But the question is, what would be the one specific metric that we should look at to be able to say that, yeah, we successfully preserved Ethereum's decentralization, even though there is a lot of institutional staking?
Yeah, I think one of the key thing is, there should be some, I'll call it self-imposed or maybe a standard, right? There should be no single node operator or entity of node operators, right? Rocket Pool included, and they should limit themselves to some maximum capacity of the network, right? I know this was a discussion a couple of years ago about, how big is too big for the health of the network, and I would hope that there would be kind of like a, I'll call it a principles of community, right? Corporations in America really, I think, have adopted certain causes: environmentalism, recycling, green, renewable energy, right? And it's become kind of a core ethos of part of that business. And I hope that some of the principles of Ethereum, as they begin to invest in that, also become part of their core ethos for it. So I'd like to see more of those standards and core principles actually being adopted by corporations, instead of them just seeing it as a financial investment, like a commodity they're investing in.
I think the number of geo-diverse and independent entities running validators is extremely important. And so if large institutions stake with 5 node operators, I think we're in big trouble. If they work with protocols like Lido and Rocket Pool and spread that stake across a large number of node operators, I think it's really a much better scenario. I can say that I think one of the most under-discussed things in Ethereum staking is actually how the large node operators that participate in both Lido and Rocket Pool and the Liquid Collective, and they run validators for individuals, are basically all the same companies. And it's one of the tricky things, but protocols like Lido and Rocket Pool also at least distribute stake to other people, and that's very, very important.
Yeah, I think the number is the number of individual entities that are running validators. And the thing is, right now, because it's permissionless, it's anonymous, and it can be sybiled, there is no way to actually count that truly. But I'm actually optimistic, as ZK becomes more mainstream, as Ethereum gets more into ZK, maybe there is a point in the future where this is concern enough to say, all right, we are going to give small individuals the way to do proof of personhood in a way that people smarter than me figure out that it's not sibillable. And then Ethereum can actually, either put an incentive in place or restrictions in place to ensure that number doesn't go down. And I think that would be super powerful.
Great. Okay, last question, 20-second answer, and then we can wrap it up. Give me one concrete prediction for the staking market that will happen, something that will happen by the end of this year. So one prediction, 20 seconds, end of this year.
There will be more ETH staked this year than there was last year. There will be more staked ETH deposited into DeFi than there was this year than there was last year, and a large percentage will go through vaults.
My prediction is that by the end of the year, at least 30% of the newly staked ETH on Rocket Pool will be staked by agentic AI.
I like that one. That's pretty cool. I think mine's more negative, actually. I think by the end of this year, we will start to see a backlash on the institutional staking concentration. I think it's really been out of focus. Decentralization has gone out of the narrative in the last year and a half, and like there's a lot of chasing yield. But at a certain point, like the staking layer centralization across the ETFs, the DATs, is something that's going to have people wake up.
Great. So agentic, vaults, and some form of backlash. On that note, we're going to end the panel. Thanks everybody for having been here, and thanks to the audience.
Thanks for having us,
See
William.
you later.
Thanks all.